Hi, folks. Good afternoon, and welcome to yet another video from the Go for Stocks family. And today we are going to look at the IT sector as promised in our previous newsletter, uh, which went out last weekend. So before we move into the IT sector, let's go through the disclaimers. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. The securities quoted are for illustration only and are not recommendatory. Registration granted by SEBI, members of BSSL in case of investment advisors, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. So moving on. So why is IT sector in our focus today? So this is what we went through in a recent Gartner publication. This is what Gartner has shared. So despite the continued global economic turbulence, Gartner forecasts that all regions around the world will have positive IT spending growth this year. And worldwide IT spending is projected to grow by 5.5% to a total of $4.6 trillion. So within this, in 2023 itself, the software segment is expected to see a 12% growth, likely resulting from enterprises prioritizing spending to gain competitive advantages through a range of software-driven transformation projects. See, on the other hand, they see a decline, will reportedly decline by 5% in the devices segment. Basically, that is based on the reduced purchasing power and a lack of incentive to buy. As we all know, Gartner is a provider of research and consulting services for businesses in the IT sector. They work with organizations to develop technology strategies, plans, and budgets, as well as to select the right technologies for their operations. So let's look at what the Nifty IT is currently doing. As we can see from the weekly chart, that the index is consolidating in a pretty wide range of 26,280 approx to 31,400 over the last 1 year. And it has made multiple bottoms. This is the fourth time, four bottoms at this 26,280 level. So, uh, so basically what it tells us that this bottom that it has been making at 26,280 is probably a strong one, and uh, and will possibly hold for uh, possibly hold in the near term. But we have to see whether it can make further up moves. That is what, and whether it can start, outperforming the Nifty or not. So if we see, this is the daily chart of Nifty IT, and in the short term, we can see that it is still in a downtrend, and only a break above these 29,140 levels will signify an end to the lower high, lower low pattern that it is currently, going through. So a break above this level, which is the previous high, lower high, will signify that the downtrend has actually stopped. And then in the short term, we can change our view from bearish to bullish. So let's compare. So with the Nifty IT performance against the Nifty, and we'll also look at the the large cap Nifty companies within this. So as we can see, the Nifty IT has been underperforming the Nifty in all the time frames over the last 1 year. The time frames here we have chosen are 1 year, 6 months, 3 months, and 1 month. While Nifty has given returns of 8.3% over the last 1 year, the Nifty IT index has given negative returns to the tune of 9.7%. And as you can see, it has been underperforming the Nifty. The Nifty IT, that is, has been underperforming the Nifty in all the time frames chosen. So if we look at the stocks now, we can see that TCS is probably the only stock which has outperformed the Nifty IT in all the time frames. While HCL Tech and Wipro has outperformed the index in about three of the four time frames chosen. But Wipro has fallen 22% from its 52-week high, and that is not a very good sign. We can see that TCS and HCL Tech are within 10% of their 52-week highs. And of course, here we can see that Infy here has been the worst performer among the pack. It has not been able to, outperform the IT index in all the time frames. So let's look at the big question here. I think the question that is in everyone's mind is Infy a buy at current levels, post the dropping it has received after its quarterly results just about a month ago. Yeah. So what we see here is that the stock has been consolidating in this broad range of 1350 to 1650 over the last 1 year. But post the announcement of its quarterly results, it fell. It made, and on that day, post the results on that day, it made a bottom at 1185. And so far, it has been able to sustain above that level and is currently trading at 1259. So below this level, below this 1215 level, it is possible that it can, even break the low of 1185 and make a dash towards 1150 levels also. And that would mean that it will enter into a longer term consolidation phase. But longer term consolidation phase would mean that any chances of a quick up move would be nullified. So what would what would it take to make for Infy to make a quick up move? It's only in case of a failed breakdown. If this particular breakdown, which has happened post the quarterly results, if it turns out to be a failed breakdown, then only we can anticipate some quick up moves and some strength back in the stock. And what will confirm whether the breakdown has failed? So it will. So only if Infy manages to break above 1400 to 1440 levels, so within the next few trading days, then only we can consider that this breakdown is indeed a failed breakdown, and then we might, think of we might start thinking of some buying. Before that, I think buying in this particular at these levels would not be a very prudent decision. So moving on to TCS, let's see what TCS is doing. The chart of TCS is almost similar to what the Nifty IT chart looks like, right? And we can see that TCS has been consolidating in the 2950 to 3550 range over the last 1 year. And 3300 to 3400 is a zone which is very key for the stock. If it manages to close above this zone, then a further up move towards 3600 is possible. So on the downside, if it breaks 3100 levels, then it will take it back towards its lower levels of consolidation. See, like the 2950 levels. So my view is that if the IT sector needs to start outperforming the Nifty, and with Infy not looking so good, TCS has to take a leadership role in this case. And here I need to mention a disclaimer that I hold TCS shares in my portfolio. So my views regarding TCS can be biased. So please keep that in mind. So let's look at HCL Tech now. So what is this particular stock doing? This is actually not too bad. I mean, this is probably the charts of HCL Tech is probably the best of the three, and in fact, it is probably even better than the Nifty IT chart, so to say. So what it has done, it has made a double bottom at 880, and and now it is consolidating for the last 6 months in a much tighter zone, which is from 1015 to 1160 levels. And this is tighter compared to the Nifty IT and TCS. Their consolidation zones are in the range of 20%, while in this case it's in the range of 10 to 15%. So what can happen? A move above 1160 can possibly take the stock towards its this pivot resistance, which is at 1300. And then if it manages to cross this level, then of course it will test its previous highs, all-time highs at 1375 levels. So let's do a comparative analysis of the latest quarterly results. So what we see here. So first of all, let's mention this, that the quarterly results have been compared with the Q4 results of last year, 2022, in all the cases. So as we can see that HCL Tech has beaten its peers on most parameters like revenue growth, operating profit growth, EBIT growth, and even the OPM margin growth. While TCS has performed the best in case of the net profit growth. While as we can see, Tech Mahindra and Wipro have posted dismal results. So, but the reaction has not been that bad actually. While Infosys has received the maximum flack post its quarterly results, but Tech Mahindra and Wipro have not done that badly so far. So that's all for now. I think in the next videos we look at the mid caps, and then probably we'll look at the small caps and also the platform companies within the IT space. So so we need a lot of motivation. We are a startup, just about a month and a half old. So we need a lot of motivation from all of you to make more videos which are useful for you guys. And so we need a lot of subscribers, we need a lot of likes, stuff like that, to keep motivating us to make more videos like this, which might be useful to you. These are a few things pertaining to us. Like, this is our website, like goforstocks.com. And if you go to our blog, which is within that website, you'll see that every week I've been posting my Nifty view in this in the blog. We also have a Telegram channel where we post more regular updates on anything to do with the equity market. You can also join our fortnightly newsletter, and this is the link. You just have to provide your name and email to join the newsletter. So that's all for now. Hope you liked it, and if you've liked it, feel free to share it with your friends and families and anyone who you know might be interested in equities and stocks. Till that time, thank you and see you soon. Bye.